Hello, my name is Moraif, Ken Moraif. And on this show, we like our bonds shaken and not stirred. Unfortunately, many of the other podcasters, videocasters, radio show, they stir their bonds. Anyway, thanks for watching this video. I am Ken Moraif, and I am the CEO and founder of Retirement Planners of America. And we're a firm that serves over 6,000 families across the country. And so what we're going to talk about this week is what happened, what we think is going to happen, and what are the important things that we should be looking at. And so, as I said, at our firm, we like our bonds shaken and not stirred. And so I'm going to talk a little bit about the bond market with you and why we think that is an important thing to be looking at. And the reason why is because we're going to learn from history. Now, history does not predict the future, but there is also an expression that says that if you don't learn from the past, you're doomed to repeat it. So pick which one you like. We like the one that we want to learn from the past. So back in the early 80s, we had high inflation, actually not as high as now, but it was very high at the time. And the Federal Reserve, just like today, decided that we have to get rid of inflation. We have to wring it out of the system, and we're going to raise interest rates. And if in the process we're going to create a recession, so be it. That's exactly what the Fed today is saying. And so what people are looking at, if you go back and you study what happened then, when did that bear market end? Well, interestingly, it coincided with when the entity, the Federal Reserve, which was trying to kill the economy, not kill it, but put it into a recession, which was causing the stock market to go down and causing the bear market. When they took their foot off the gas of all of that, that's when the bear market ended and when we saw a recovery start. So how can we measure that? What can we look at? Well, there's a very important number. It's called the 10-year Treasury yield. So what is the 10-year Treasury yield? Well, let me tell you, let me show you. I'm going to share my screen with you. And this is a chart that shows you the 10-year Treasury yield. It's the interest rate that the bond market is expecting the Federal Reserve to raise interest rates to, if that makes sense. Okay, so it's a forecasting mechanism. So what the market right now is saying is they think the Fed is going to raise interest rates all the way to 4.239%. Pretty accurate number there, right? 3 decimal points. Man, the market is like really accurate when it predicts the future. But the interesting thing is, if you look at this, is that you can see that interest rates earlier this year, at the beginning of this is January through October. And if you look at the beginning of this year, interest rates were less than 2%. Now they're over 4%. All along the way, the bond market has been wrong. It has been saying that the Fed is not going to raise interest rates. They're going to stop. They're going to slow down. That's what's happening today as well. There's this drumbeat of optimism, if you will, that the Fed is not going to raise interest rates and harm the economy. They're going to let up at some point. And right now, there's a feel that they might let up. But be that as it may, you can see how rapidly that yield, the interest rate that the 10-year Treasury note is paying, which is a reflection of the expectations of what the market is going to do, of what the Fed is going to do. So if you go back to the 80s, what happened was that when interest rates peaked, and folks, they peaked at 18%. We are at 4 now. We're a far cry from where it was with inflation not as bad as today. So we don't believe that interest rates are going to stop at 4.5% or 5%. We think they're going to go beyond that, but that's what the bond market is saying right now. Now, if you go back to the early 80s and you look at what happened, when the 10-year, the Treasury yield peaked and started coming down in a sustainable fashion, that coincided with the end of the bear market and coincided with a good time to potentially buy back in. Why? Because the Federal Reserve was raising interest rates to put the economy into a recession, and in so doing was driving the stock market down too. The moment they stopped doing that, then it was like, okay, it's safe to go back in now because the big gorilla has left the room, if you will. And so this is a very important number to watch. And as you can see, you can find it on MarketWatch, you can find it on Google, but if you want to do this at home, you can do it for yourself. The other thing also that we look at in our firm is we have a number that we measure, that we've quantified in our view, which is the when the market has reached capitulation. And historically, when the market reaches capitulation, meaning that investors have given up all hope and they've sold out, they've panicked, and the baby's gotten thrown out with the bathwater. When that happens, then what happens is that the bear market is usually over. And we have looked at, with our research, and we think we have a way of measuring when that capitulation point comes. And that's when we'd be looking at buying back in, but we haven't reached that yet. So we think the worst is still yet to come. It ain't over yet in our view. So if you would ask me, is this bear market over? The answer is, we don't think so. We think there's a lot more downside still to go before we're done. So what should you do? Well, one of the things that we've done with our clients is we are in cash. We're in the money market fund. And the good news about the money market fund is that as the Fed raises interest rates, guess what? When the Fed raises interest rates, the interest rate we get on a money market fund goes up right along with it. So you're safe and you're getting paid to be safe. We think that's a good thing. So what I encourage you to do is visit with one of our retirement planners. And you can do that by going to our website. And that's rpoa.com. If you're over 50, we'll visit with you at no charge or obligation. We'll build a retirement plan with you. We'll talk about how you should be invested in our view right now. And we'll help you to make some decisions and hopefully survive this big mess and this terrible time that we think we're about to head into and that we are already in. Now, you may be wondering, why is Ken wearing a tux? Well, the answer is because I appreciate you watching this video. That's why. No, actually, the reason why I'm wearing this tux for today is that I'm going to a wedding. My youngest daughter's best friend is getting married. And I'm not in the wedding. I'm just a spectator. I thought I could go in a t-shirt and a pair of shorts, but my wife said, no, you are going to wear the tux like everybody else. So that's why I'm wearing my tux. But, you know, maybe from now on, I think I look good in a tux. What do you think? Maybe I should wear this every time I do the weekly videos for you. Anyway, thanks for watching this video, and we'll talk soon. Oh, and by the way, share this with as many of your friends as you wish, okay? Please do. We want to help as many people as we can. So again, thanks for watching this video.